Deloitte Tax. Welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views, and today is the first of our Crypto for Tax micro-series. And today we're going to focus on crypto tax basis tracking. So we're certainly seeing an increased usage of crypto amongst traditional businesses. So in this episode, we're going to dive into the new tax rules that dictate how taxpayers track and recover basis in crypto assets. So this is relevant to those who invest or trade in crypto, as well as those who use it in business. So we're going to discuss the nuances of this new asset class with relevance to the technology, how it's custodied, and the importance of books and records in supporting the tax outcome. So we hope our listeners will acquire the knowledge on effective wallet structures and tax planning considerations so that they can enable the tax efficiency as well as have a practical approach to crypto tax basis tracking in their organizations. So joining me today are Rob Massey. He is the founder of Deloitte's crypto practice over 13 years ago. And he's joined by two specialists in Deloitte's blockchain and digital asset area from our Washington National Tax Practice. So joining us from WNT are Claire Bogger and Connor O'Brien. And Rob, I will start with you. So as I said, crypto is more commonly being used in traditional businesses. Can you talk about the common transaction flows that we're seeing?
Absolutely. Thanks for having us, Carrie. There's really three use cases that we're seeing among the larger enterprise looking into crypto. The first is diversification on the balance sheet. And this is where, the treasurers are really looking at examples. They're looking at maybe peers in the market. It's become a common conversation. They're making bold moves with Bitcoin, looking at, short-term and long-term deployment and uses of capital, comparing that to other deployment of capital. They're also looking at cross-border payments. They're looking at the speed, the ability to satisfy your company, and even an increased number of vendors wanting to take Bitcoin or other forms of crypto as a method of payment. And then an increasing number of customers that want to pay with crypto, employees that want to get paid with it. And I already mentioned vendors. That's just not happening abroad, but it's also here. And with each of these considerations, we're looking at a unique lens for tax and accounting and controls. Because crypto, while it varies a lot in its type, it varies a lot in terms of how it's treated compared to cash or other investments. It's property of some kind. So when you're using crypto in these transactions, you're looking at property transactions or barter transactions, as we'll frequently call them, with unique things around how you calculate gain or loss, looking at the characterization of a transaction or property. In this podcast, we'll be talking a lot about basis tracking.
Okay, that's great to get us started. And so, Connor, maybe you can start us off in terms of what corporate tax departments need to be thinking about in terms of these transactions.
Yeah, that's a great question, Carrie. And, I think I always like to start with, and I think any corporate tax department should start with just understanding what the corporation is planning on doing with the digital assets. If it's merely gaining some exposure to, let's say, Bitcoin on the corporate balance sheet, it may be a relatively straightforward task of understanding whether or not the asset is a capital asset or an ordinary asset in their hands and being able to adequately track the basis, recover it in alignment with the regulations that were released last summer. However, we see a lot of companies that may be interested in actually using these digital assets in a more operational manner. And this comes with it a lot more questions from a tax standpoint. First off, you're going to be having barter transactions left and right? It's not very frequent that we are actually paying expenses that may be a deductible expense with property. And in a transaction like that, you need to think about a few things. First, I'm going to realize a gain or loss when I use this digital asset. So what's the character of that gain or loss? Second off is, how do I report the other side, which in traditional world was usually cash, but here if it's a payment for an expense, how is that flowing through my system so that I can adequately track all of that? And, you might have additional considerations on character if you're actually using digital assets in the business, because it's not often that every digital asset is going to be deployed for a business purpose. You might also hold some as an investment. So that character determination It gets a bit harder when you have some that's investment property and some that's actually used in an operational flow. And I think the last thing to consider is really, how do I deal with accruals if I'm actually denominating contracts in digital assets, right? We're all familiar with, when is my expense fixed and determinable? Well, if you have an expense that's fixed in units, it's a different question and it's a hard one to tackle.
And we are seeing a few more transactions come up like that, people actually denominating their contracts in units of crypto. And that's a bit unusual, right? Most of us listening today are probably US dollar denominated taxpayers and their financial statements are denominated in US dollars. So when you have something that you're contracting in something other than fiat currency, that does really unusual things in your financial statements, but also, to Connor's point, revenue recognition and expenses.
One other thing I'd add, Connor, is that the new Treasury regulations released in 2024 make it clear how to implement specific ID or the default FIFO methodology to the taxpayer's wallets or accounts.
That is a great point. We did receive a pretty significant regulation package last year for tax basis tracking. Could you give us an overview of those rules?
Sure. So one of the key takeaways from the new regulations is that each wallet must be respected as a separate pool. So what was happening previously is that taxpayers could have both a self-custody wallet and an exchange account. And when they went to recover basis, they were applying FIFO on a universal or multi-wallet basis, regardless of where the asset was held. And this practice was seemingly acceptable under prior guidance. However, once brokers start reporting basis in 2026, the universal wallet approach could create a mismatch or conflict between what the taxpayer is reporting and what the broker is reporting. So what the new regulations do is they follow a wallet-by-wallet approach for recovering basis in digital assets. So the next question is, well, how is a wallet defined by the regulations, and what does that mean for taxpayers? So a wallet is defined as a means of storing electronically or otherwise a user's private keys to digital assets held by or for the users. For some taxpayers, their wallet groupings might be straightforward. But other taxpayers might have a more complicated wallet setup, including different types of self-custody wallets where their wallet groupings are less clear. So for example, if a self-custody taxpayer stores multiple private keys on a single computer system, is this an example of a single wallet or separate wallets? And the same question is posed when a taxpayer enters one seed phrase on multiple different computer systems, allowing the same private keys to be accessed on multiple devices. And so despite this ambiguity, there are two differentiations that the regulations call out that could help inform a taxpayer's wallet groupings. The first is between hosted wallets and unhosted wallets. Unhosted wallets typically refer to a pure self-custody situation, and hosted wallets generally involve a custodian. But note that you could have a hosted wallet with a custodian who is not considered a broker for purposes of the regulations and will not have an information reporting requirement. So there is a little bit of nuance there. And then the second distinction is between a hot and cold wallet. In a hot wallet, private keys are held in a manner that is accessible when online. And in a cold wallet, private keys are held offline and never secure a connection with the internet. So despite the ambiguity in the regulations regarding what constitutes a wallet, those are two distinctions that are relevant when a taxpayer creates their wallet groupings. And a second takeaway from the final regulations is guidance regarding basis recovery methodologies available for each wallet. And the regulations break out these rules into two categories. One for digital assets that are held by a broker, and separate rules for digital assets that are not held by a broker. For both sets of rules, the general takeaway is that taxpayers can specifically identify the units of digital assets sold, and if they do not spec ID, then they default to FIFO within that wallet. And for both sets of rules, the specific ID must be prior to or contemporaneous with the sale, meaning the taxpayer cannot use hindsight. And then starting with self-custody, taxpayers can apply specific ID by using a books and records approach to contemporaneously identify the asset sold. And so the concept of self-custody is not something we typically see in the traditional securities context, as there are not many taxpayers these days who are holding on to their own stock certificates. So an area we've been helping clients think through is their systems and processes for applying Spec ID to their self-custodied assets. And then for taxpayers who hold digital assets with a broker, they can apply specific ID by giving instructions to the broker regarding which digital asset to sell, and standing instructions are also permissible. The regulations also mention that the broker has to deem the identification sufficiently specific, meaning the broker must have systems in place that enable the use of specific ID. And finally, in December of last year, 2024, the IRS gave a holiday present and deferred this specific requirement for a year. And so the temporary relief provided by the IRS allows taxpayers to use a books and records approach when applying specific ID to assets held by a broker. And this relief is currently in place just for 2025, as brokers continue to evolve their systems to enable specific ID going forward.
Well, you made a bunch of great points in there. One I'll put a little emphasis on, and that is the significance of the reg package going into the explanation of what is a wallet and self-custody. Like you said, this is not normal for people to be self-custodying their financial assets, but it's very much in the world of crypto. And so, I think there's a lot of instructive guidance, clearly more to come, but the definitions and I think practical applications of self-custody and wallet structures is pretty helpful. So we're really happy to see that.
Yeah, I can see where those definitions are helpful as tax organizations just become familiar with this area of the business world as well, in terms of understanding some of the options. That was a lot of rules. Connor, what best practices do you have for tax departments as they implement these rules?
Listening to what Claire was just talking about, it's all of these corporate tax departments are going to need to think about how to implement a system to track all this activity. You can do as much tax planning as you want, but if you don't have the underlying data to support your transactions, it's going to be useless at the end of the day. And we're dealing now with a new type of asset, a new type of property. We're dealing with new data sources for where those transactions occur. And, a lot of corporations aren't ready to actually implement this into their ledger system. So it does kind of require the use of one of these crypto subledger systems probably to adequately track this activity. And, anytime there's a change, a structural change like that, it's difficult to implement that. And there's a lot to think through, especially given that there's a lot of questions about what this property actually represents and how it might impact certain transactions. So I think step one is really thinking about the process and what you need to do in the corporate tax department to actually implement a good system and to establish good processes and procedures internally to make sure that you're efficiently transacting with these assets. It's kind of unknown where corporations are going to take this. And as I mentioned before, there are some sticky situations where you might be holding a crypto asset as both an investment property and you might be using it in your operations for a specific purpose. And whenever a situation like that comes up, it really puts an extra emphasis on the basis tracking rules. And, you really need to drive down to that wallet level or to that account level to make sure that your positions, especially on character of the property, kind of are true all the way through. You might have specific considerations, especially if you have a non-US sub, as to whether or not income that's recognized from the use of digital assets there is sub-F income or if it's potentially eligible for GILTI. There's also just the standard tax considerations that you have for capital assets, right? That we're kind of all familiar with. Contributions of long-term capital gain property to charitable organizations is one that we see, every year near the end of the year, questions about contributing crypto to charitable organizations. The other kind of low-hanging fruit is just efficient management of your capital loss limitations and making sure that you're adequately implementing a system to track your basis so that you don't run into a situation at the end of the year where you generated a bunch of capital loss that you can't utilize in that year. And you might have had lower basis assets that you could have used to efficiently recover that and not have that capital loss that you can't utilize, or even worse, generate capital gain when you could have been in a tax neutral situation if you effectively managed your basis. All of this really comes down to just process and procedures of implementing a new system and really thinking soup to nuts, how is this going to play through and what is the company doing with digital assets?
I think that there's a lot to do here, knowing that this is property. And in many ways, crypto behaves like fiat or primary means of payment, but there's just all these other considerations. So you always have to pause and say, what is this thing that I'm using? How is it treated? And how does the transaction differ because I'm using crypto than normal fiat currency?
So, Rob, I hear that there's a new BNA focused on crypto. I assume these rules are covered there, and tell me more about it.
We did, Barry. We wrote a book. we published a BNA portfolio entirely dedicated to crypto. It is sometimes referred to as a treatise. It's almost 400 pages of technical documentation. It covers a full span of what we think to be, all of the relevant tax considerations of crypto. Connor and I are the two primary authors, but there were over 50 Deloitte leaders who contributed to this piece, including Claire. Much of our national office contributed to this piece, and notable because our specialists, which transcend all the different tax competencies, do have a specialization and experience in dealing with crypto. So we try to do is bring that to life throughout the portfolio. It absolutely covers basis tracking, as we've spoken about. There's a lot in character. There's a lot about crypto financial products based on crypto, international, cross-border, multi-state, heavy on info reporting. That was another big reg package we got. So it's out there. It's online. We're really proud of it. We do try and keep it updated. There's new rules all the time, but it's a pretty cool piece. We're very proud of it and hope that you find it beneficial.
Absolutely.
Rob, one other thing that I'd like to add there that it does provide a relatively user-friendly explanation of what some of these transactions are, right? Your corporate tax departments, this might be their first time having exposure to crypto. So it's helpful in that respect as well.
I'm glad you mentioned that. The BNA does go into a bit of depth in explaining what these transactions represent relative to being able to digest it from a tax perspective. You can do research on, what do these things represent? And a lot of what's out there online is confusing and inconsistent. So what we tried to do is bring up a balanced, thoughtful perspective into representing what do these transactions represent so that you can then evaluate with a consistent group of data points and then apply the tax rules on top of that.
That's incredible. And I'm sure we're going to have some very interesting discussions on some of those topics as we continue this micro-series. Well, thank you, Claire and Connor and Rob, for these insights. I guess beyond going and reading the BNA, there is more information on our blockchain and digital asset practice. If you go search on those words on Deloitte.com, there's an insight tab with lots of points of view on lots of topics. So I'd encourage our audience who's interested to go check that out. As always, audience, thank you so much for listening in. Be well, everyone.